What's going on, everybody? You know who it is. It's Austin, aka More Than an Agent. And here we are on another episode of the Real Estate Blueprint Podcast, the podcast for the Black and Brown community. And here I am with my Dominicano hermano. Is it hermano?
Hermano, that is correct.
Hermano. I can still roll the tongue, so hermano, pause. And John Soto, what's up, champ? How you holding up?
I'm doing well, man. Great day, great energy. I want to just give value back to our folks, make sure they have the information to make the right decisions to proceed with their lives.
I'm here with it. So today's episode, the do's and don'ts when buying and selling. So that way, because I know market's crazy, it's been crazy, there's nothing new. And we just want to make sure that you all are equipped with the knowledge so that way you can avoid as many mistakes as possible. You know, me and Jonathan have made mistakes in the past, like when buying our own properties. And we've seen buyers make mistakes, and we're here to make sure that on your mortgage end, when you're buying, and for my sellers out there that are ready to get, cash out, we want to make sure that y'all are good so y'all don't make the same mistakes. So first things first, what are the common mistakes that people make just when going after their mortgage, like as they're starting or even during their buying process?
I would like to say the number one mistake is people assume. So number one, assuming that whatever the situation is going, it's fine, or assuming that they don't qualify. So we have two folks. Some people think that they could do a quick Google search and they could get the answers, not knowing that they could just pick up a phone call, speak to the lender, and get the information. A lot of people don't approach a lender sooner rather than later. They want to do it right before they're putting an offer in a house. That's not the case. You want to speak to your lender as soon as possible, as soon as you get an idea of you want to buy a house. So you want to know where you are, income-wise, credit-wise, because there's a lot of things that can prevent you and will prevent you later down the line. You don't want no fire drills at the closing table or 2 weeks before closing. You want to know ahead of the game. So I like to break down things with three categories. Number one, income. Number two, credit. And number three, assets. We could definitely there's definitely issues with each line item that I've seen in the past, more recent, definitely. But number one, let's talk about income. So I actually got this issue probably like 2 weeks ago. The transaction was going fine. We got the clear to close. The day of closing, the bank actually does a phone call, a verification of appointment to make sure that the client is still working. So I get the call from my underwriting. The person is not working there anymore. They just changed jobs the week before. So number one, please do not change jobs during your transaction. If you're going to change jobs or you're in the process of changing jobs, you got to offer, please communicate that to your lender. Don't assume. Don't think it's the same type of job, more money, it's fine. Don't assume. That person was assuming, okay, same position, different company, more money. That's not the case. Well, it was the case for that. Luckily, that person was actually going to the same position. We did a fire drill. My underwriter came in place, my processor came in place, and we closed the next day, 24 hours later, because everyone was hands-on. Not many banks will do that for you. They notice that you're changing jobs, maybe they can delay it, and they don't have the manpower to actually process that in a fast timing. We needed paperwork from the HR because that person did not have a pay stub yet. We needed a lot of information from the HR department to confirm that she actually is working there, what her income would be. So that's something that I just recently experienced. Income. So another part on income I want to say is, don't assume that you have a W-2 job and you switch to 1099 making more money, don't assume that you can just buy a house. 1099 income is completely different.
That's happened.
That's happened a lot in the past. When it comes to 1099, you're self-employed. There's no tax taken out. Of course, at the end of the year, you basically tell the IRS how much was your actual profit. So the bank has no way of calculating that income. So they need 2-year average of your tax returns.
That happened to me.
That happens. So that's on the income side. Another part of the income side is make sure that you work the same hours. So you've been working this. So when it comes to hourly pay and overtime, the bank will take a 2-year average. But if they see that reducing or anything, that can impact the qualification. So your income can be impacted. Let's say someone pre-qualified you at 80K with income, hourly, bonuses, and overtime. But for whatever reason, this year, that overtime is declining or non-existent, possibly depending on what the actual company says. You may not be able to use that overtime and you qualify for less. But that's the majority on the income side. I want to take a pause there and see some of your experiences on the income
The interesting part about it is that like in starting, right? In starting and getting an idea of where you're going to be at is one of the most important parts. And I think like most people, to your point, they assume that either they're a lot more further away than they are, to the point where they never even see where they're at to begin with. Like they think the target's so far that they don't even get an action plan and a roadmap, because most of the time, like you said, it's either debt, it's either credit, or it's something that can be adjusted financially, like on their particular profile, that will then either speed up the process or put them in position, sooner rather than later, to be in a position to actually buy a home. So and my like thing, and I know it's just like the first step, and I know it's like, but it's not going out there pre-approval to even know where you stand, because then that makes things more real. When you're going and you're sitting down with a mortgage officer and you're able to talk through like, okay, here's what the down payment's going to be on this particular loan. Here's what your monthly payment is going to be. You're able to see your down payment. You're like, okay, I either have that or not, and I have an idea of when I'm going to be able to save that or not. And then your monthly payment, you're going to know right off the bat where you're going to stand on a monthly income standpoint of where you need to be or where you're currently at, and that's either going to be good or bad, right? As long as you have the numbers. After that percent, like here's one mistake that I think I don't want anybody to make like right now. Like, I don't want anybody to make the mistake of buying for appreciation, right? Like, this is not a market where we're in here claiming about how you're going to get, whatever X return, right? What we can tell you is that we're on the top of the market and the tippy top, and where we don't know how long it's going to be sustainable. And if you're buying for appreciation, if you're buying for appreciation in the short term, I don't want you to do that. Buying in the long term, obviously, is something, that we're considering it. But for my starter family homes, right, and my people that are looking for this, like, starter families, you really want to pay attention to the mortgage payment, because that's going to be the end all be all. And you really, really, really don't want to be, like, you want to be extra careful for everybody that's buying in the 3 to 5 years. And the reason why I say that is because when you're buying in the 3 to 5 year time frame, you're more likely to ask the question, how far up is the market going to go? Like, where are we going to be able to sell, in the future? It's going to, you really, really, really want to stay heavily mindful about how you're bidding and what mortgage payment you're signing up for, because those things can turn. So for me, at least, buying for appreciation at this point might not be the smartest move in the short term.
Okay.
But if you're buying your home that you're definitely going to be in there to ride out whatever wave, whenever it comes, it might continue to still go up and, over the next 2 to 3 years or 5 years or so on. But we don't, because we're buying at the top, buying for appreciation or speculation in the short term is not the best move. And we want to make sure that we're buying in order to hold for the long run, at least to see our equity position increase, unless we're going into a property that we're doing work and we're forcing the appreciation and we're adding value to the property, which obviously can be done. But on the buy side, like, yes, that is my one thing. Well, that's my one to match you. And I'll throw one more in there. Overestimating your numbers is something that obviously you would want to stay as many steps ahead as far as overestimating your numbers. So what does that look like? When it comes down to your principal and your interest on your mortgage, those things are going to be fixed, right? So your mortgage payment is going to be your principal, interest, your taxes, and your homeowner's insurance.
Well,
the principal
except for tax and insurance, that can vary, remember.
So that's what I'm saying, right? So like you have your fixed monthly mortgage payment. That's going to be your principal, interest, taxes, and insurance. That's going to make up your monthly mortgage payment. Your principal and your interest. So everything that the lender gives you, that's going to be fixed unless you sign up for an adjustable rate mortgage, which we don't necessarily agree with, especially after everything that happened in 08. So fixed. It's a fixed principal.
Arms are different now than 08, but that's a whole different conversation.
Adjustable rate mortgages. Yeah. Either way, your adjustable rate mortgages can adjust with whatever's going on, right? And your fixed rate, which we, kind of promote more often at least, or at least what you find more often people sign up for. Your principal and interest are fixed. Your taxes and your insurance are the only two things that can definitely change on you. And most likely, taxes for sure are most likely always going to go up. So always factor in a budget and a conservative amount, and always be sure to make sure that if your taxes jump and makes your monthly mortgage payment go up, that you are able to still comfortably handle the monthly mortgage payment. Homeowners insurance usually stays the same unless for whatever reason in your local area, something changes where now all of a sudden you need flood insurance, or now you're in a tornado zone, or if you happen to make a claim and you obviously use and tap into your ability to use your homeowners insurance policy, that can also rise it. Am I missing any for the most part?
No, that's good, but insurance typically it does go up because the price of everything goes up, so insurance can go up, but it wouldn't be as big as of a jump if your taxes to go up. It would be 20, 30 bucks a month, unless you're switching from a primary to an investment property. Typically investment property insurance are more.
Correct, yes. But when getting all these numbers, just don't assume that the numbers that you're getting, whatever estimates that you're getting, that you don't change it and be conservative with it, because in that particular case, you're going to shoot yourself in the foot. So that's another one I'm gonna throw at you just on the buy side.
All right, the next side will be credit. So when it comes to credit, people are definitely scared at the beginning to run their credit to get pre-approved. They think it's too early. Yes. They don't want to get, but if you're really trying to buy a house, 2 to 3 points would probably be the max for running your credit one time will probably be impacted. If you're not running around your credit multiple times, month in, month out, open a whole bunch of new trade lines or anything like that, your credit is not really impacted. You won't really see it. So that's why, of course, I can give people ballpark estimates without running the credits, but really that buyer is not really in it, because if you're really in it, you want to run your credit, get more exact numbers, because estimates, that's what they are, estimates.
We're so scared of credit.
Take it and run with it.
We're so scared of credit.
People are so scared of credit.
Like
credit
score is
meant to be used. What's the point of having an 800 credit score if you don't utilize it, you don't leverage it, you don't do anything with it? Right. There's no point of it. So you have to
And there's
use it
nothing even
wisely.
bad with the 800 credit score. It's just the fact that like, if you're not where you are, want to be financially, then like, here's your opportunity to
Mhm.
like, do
Yeah.
something.
And another reason I like running credit up front, because until someone finds a house, it's better to run it up front to see exactly what's going on. Maybe I can give you some tips
Mm-hmm.
to bring it up higher, get you up to next tier, get you up to a better rate, get you up to easier qualification. Maybe you're right below it. Uh, I could get you above that. Maybe you have a repo that's something happened and you're that won't qualify you. So it's better to be ahead of it, run your credit up front, know what's going on, let the lender take a look at it, and there's no issues later down the road. But when someone actually has a home under contract, avoid buying a car. One, avoid impacting your debt to income ratio. So if you have a certain percentage, you don't want to increase your debt and disqualifying you. You don't want to buy no new furniture. You don't want to have any big purchases. You don't want to take any loans out. You don't want to do any of that that can impact that, because the banks, they have a monitoring system. And if your credit is ran, you open in new lines, they get an instant alert. So try to avoid running your credit, getting a new car, changing your car to a higher payment. If your lease is up or something, people go to a higher car, higher payments, and that can disqualify them. So definitely avoid that on the credit and make sure you make your payments. I've seen someone miss what is it called? A department store card, miss one payment by one day, their credit dropped like 40 points.
Mm.
So make sure you make your payments. Don't open any new lines. Don't run your credit for a better transaction.
To keep in mind, like, with credit, like it we're gonna make it so easy. Long story short, it's here to help you. It's not here to hurt you. It's here to help you and here to hurt you. And credit can always be rebuilt. So keep that in mind.
Yes.
Um, for anybody that's like continuing to buy in this market, and I know with bids, here's a core concept of what's going on, and I want people to take an extra step in their due diligence process when these things are happening. But the reality is, the nice homes are getting multiple bids, and people are giving up a lot more than what they normally would as far as negotiations. Specifically, what I'm referring to is the home inspection and the appraisal, right? So in this market, just think twice when us agents and are advising on what to do about the home inspection and the appraisal. It's not to scare you, hurt you, or anything like that, but always keep in mind, so that way if the agent's not bringing that up to you, you know what to be looking for. And in this particular case, for your home inspection, a lot of people are just limited to the structural, environmental, mechanical, the big ticket items, right? Your plumbing, your electrical, your heating, your cooling, your roof, your foundation, the siding, anything that is compromising the basement floor. So big ticket items, right? And while this might be the case, what it completely ignores is the fact that you can't see behind the walls of majority of these homes when you're buying these properties. So because of the fact that you have limited your home structural to structural, environmental, mechanical, and although the outlets are working, right? There's nothing wrong with the outlets. So but then after purchasing the home, you find out that you have a major electrical issue behind the walls. And I want to put emphasis that majority of home inspectors are not going to be getting behind the walls. They can't be getting behind the walls. Electrical panels, sure, and they can give you an idea of especially the electrical layout, but like that's just an example of your home inspector won't be able to get into everything. You can bring out other contractors, but you'll want to be able to dive deep into what you are signing up for, that you're limiting your home inspection. And that's just one example. And then on your appraisal, a lot of buyers are one, overbidded, and then paying above what the bank, at least in that, or the lender in that case, believes the property is worth via their appraiser. So what you're essentially saying is that, and agreeing to, is that, hey, although the lender's appraiser who's on your side, who is on your behalf, because they don't want you to take out, and they don't want the bank to give you more than what they feel like the property is worth, if what you are signing up for is saying saying that whatever the property is worth, I'm willing to pay above that. And that can help you and that can hurt you. You're gonna want to factor you're gonna want to factor in exactly what you're getting as a product, whether it's a single family like home that you're going to be paying a mortgage on, whether it's a multifamily that's going to be paying you. Going over doesn't necessarily mean a bad thing. You just don't want to go in too deep where you set yourself up for failure if there is, when and if there is a market correction, or if it's a multifamily that your tenants aren't able to cover the rent, and now you're covering a lot more than what you originally expected. So that's a fundamental concept of what's going on there. People are waiving their home inspection and eliminating their need to do a thorough home inspection. So something that I want people to keep in mind.
Yeah, definitely. Just to add to that, you want to work with people that have the best interests for you, that are really working with you, not against you, not looking at you as a number, not looking at you as just one transaction and done. I'm more of a relationship long term. I know you are as well. I want to do what's best for the client. I want to be completely transparent as possible. Nowadays, especially with the rates going up and up, it's more common now, people paying for points to either qualify for the loan or just bringing their rate down to decrease their lower their monthly payments. So that's something just to keep in mind. And it's always good to have more cash in your bank account, because you don't want to be house poor. You don't want to spend everything, go above appraisal, do this, say ignore to all the inspections, and then come to find out you have a house with this payment and you don't have any funds to fix anything you want to even live in the house, to feel comfortable. So just keep in mind who you work with. The next one I want to touch on, which is the last one, which is of course the income credit assets. You can typically you can't really get a higher income typically quicker. With credit, you can always fix credit, as you mentioned, use it. And when it comes to assets, it's tough. If you don't have 100K in your bank, you're not going to have 100K the next day.
Right.
So credit is usually the one that is more flexible sooner rather than later than the other ones. So when it comes to assets, you want to know what exactly you have in the bank. What's worst case scenario for closing costs? What's best case scenario? What maybe down payment will be. If you have to go above the appraisal, don't assume it's going to appraise. A lot of people are throwing very higher offers out there. It may appraise, it may not appraise. So just be aware of that. Don't go out and make big purchases. I've seen a lot of people, I'm seeing the bank statements. I'm like, what is this big purchase about? What's going on? Oh, I just bought some furniture because I'm closing next week. Don't assume, just from the beginning that I mentioned the assumption piece. Don't assume that closing is just a down payment. You may have, if you're not having a concession, a seller's concession, you have to come up with the closing costs. And nowadays, I'm seeing more and more people paying for points because they needed to qualify. To qualify for the loan because their debt to income ratio are maxed out because the rates are higher. And just the rates are, but where the rates are right now, it makes sense for them to pay down points. Well, for most people, some people that can qualify, it's fine. They don't have to. So don't assume that it's just down payment. Don't assume that the seller is going to give you the concession. That can be removed in case you ask for, if the house under appraises, if a lot of stuff can happen within a ready transaction. Don't assume. Have funds in the bank. Don't spend your money. Save it, close it, and have reserves. It's always good to have reserves.
I'm gonna wrap up on the do's and don'ts in this particular market for buyers and sellers. For my sellers, like here's what I've experienced over a couple transactions recently, in which, you know, I get it. And here's the biggest thing that are hurting sellers. And one is listing way too high, right? And choosing to, you know, when trying to take advantage of the market, which we completely understand. But then there comes a point where, you know, if you listed too high, that, you know, the less amount of buyers that are in that particular like playing field for that particular house, at least for what you're offering just as a product to the market. And, you know, it's the being afraid to adjust the price, right? Like being afraid to adjust the price can be detrimental to like the ability to procure the right amount of buyers. And I like to compare it to a stock, right? Like if the property's sitting on the market at a particular price and there's no buyers for it, if this was stocks, then that price would drop like into the next available bidder, right? Which, you know, stocks falling on a more consistent, like volatile wave than real estate, right? So stocks go down on a daily basis, they go up, so on and so forth, right? And as the stock is falling, it's going to continue to fall until it finds a market for whatever price that it's, you know, currently priced at. And with real estate, the only difference is that the price will remain the same even though there's no buyers for it, right? So like in stocks, it's going to, if there's no buyers, it's going to drop. It's going to drop until there's buyers. Like that's just the reality of it. And in real estate, it can still be priced at an amount where there's no buyers, considering the fact there's no offers. And when that adjustment doesn't happen, it further prevents the opportunity to procure a buyer for your asset, for your product, for your property. And, you know, agents, of course, like we're going to try to give the most amount like for you because obviously we make more. But if it's not happening, and then the only reason why we don't want it to adjust the prices is because we think that people are going to think that there's something wrong with the property, like that further hurts your chances of procuring a buyer. Because if a stock is priced at a price that nobody wants to buy it at, and if the company's like, well, we don't want something that, like, we don't want the general public to think something's wrong with our stock, there is something wrong with the stock. Like either it's not producing, it's not doing what it's supposed to do, or like people are just selling off because like they made their profits. That's fine. Like, but for whatever reason, there's no buyers at this particular price level. So something's gonna have to change. And if that can just happen for anybody that's selling whose house is on the market for a while, and no buyers, there's always two reasons why sellers, or properties don't sell. It's either price or it's a condition. That's it. That is it. It's either price or a condition. Whatever you're offering is either going to be price, condition, and I'll say features. Price, condition, and features. Whether that's features of the property, features of the area, features of the location, but price, condition, and feature. Those are the only reasons why a property will or will not sell. And if it's not selling, there's one of the reasons why. And we really have to recognize that the market is going to prove itself no matter what. So for my sellers out there, like, yes, people are still selling with no problem and things like that. But I'm in one transaction where my buyer is purchasing the property, and the seller's getting a little greedy. The seller's getting a little greedy to the point where it puts strain on the transaction. And obviously, no seller wants to be in a position where the deal falls apart and then they have to start all over. And in that particular case, like that, all those things have to be factored in. But and then I have my one seller where the property's not moving, and we're getting the feedback, we're getting the showings, and the property's just not selling. I genuinely believe that it's just because it's at a certain price that's not attracting the right buyer at that, at that level. So for my sellers, just be respectful of the market, because I'm saying that even if you choose to list high and there's buyers that are coming after the property, then you're still properly priced, right? Like Apple keeps going up, right? In the long term, right? So like there will be buyers still at higher prices. I'm not saying that. But if it's not selling, then there's genuinely a reason why. And don't be afraid to adjust.
It goes back to the assuming part. They're assuming that they want this number, so they want to list it at that number. You don't technically have to list it at that number. That's the number you want. You can list it a little lower and have, especially in this market, everyone's bidding over asking.
Mhm.
But if the asking is too high, no one's going to bid at all.
Right.
So if you want a number, that goes back to don't assume. Listen to your team. Listen to people who are in the field that are actually doing this, and trust them. Trust and verify.
Yeah, whoever they are, because there's more than enough, like, and this won't even be a selfish plug. Like, obviously we're doing it, but like we know a lot of people in the game that just know how to do this business, know how to actually execute like on the action plan and getting things done. And the reality is just the fact that like we don't want to come off as like arrogant, but at the same time, like eventually there's got to be a threshold where it's just like I've clearly bought more properties than you. And at what point is it like, I think I do know what I'm talking about, or I do think, I do know what I'm talking about. If I'm like saying the property's not selling, here's the reasons why, here's what we can do about it. I'm always going to give you options. I'm always going to give you options. There's always instructions. I'm sorry. It's always suggestions, never instructions. But at the same time, like, it's just like, however you want to like go about it, just don't be surprised if X, Y, and Z happens, right? So like, this is just the reality of it. And it's all with love and all with, because y'all are coming to us and y'all are coming to your respective agents and mortgage professionals and lenders and title companies and home inspectors. You're coming to them for them to be able to service you at the fullest potential. And you obviously want to be in the position to win, which is why this particular episode is called the don'ts. So like we're telling you don't for a reason, because here's what happens as a result.
It's
So in that
your
particular
actions.
case, like
Don't do it.
right? Like I remember when I was flipping my first property, I was selling my first property, and I had it on the market. Like I was asking for some outrageous price. I was like, no, we'll be able to take advantage of it, right? So I listed it high, like, and I didn't get offers, right? Didn't get offers. And this was a property in good property in a solid location, right? Highly desirable location. And it would have been gone. There should have been no reason why it didn't sell. But obviously I knew that it was priced too high. I adjusted the price, we got under contract immediately, right? And I went under like, and it's still, when you're priced at that right price, you're gonna wind up receiving, bids, and you're gonna wind up receiving competition. But if I would have kept it there, I would have like sold it. And if I didn't sell it, like I wouldn't have been able to close on the next deal because I needed the funds in order to close on the 5 unit that I was going to purchase. So yeah, man, it's not, the market will always prove itself.
Yeah.
I'm here for it. So listen, don't be afraid to subscribe. Definitely tap in. We're going to be bringing some more heavy hitters onto the show. We're in the midst of some recordings. So definitely hit that link in bio, get your home buying journey started. Whether you're looking to get pre-approved, whether you're looking to refinance, whether you're looking to buy, sell, invest, rent, whether you're a landlord looking for tenants, whether your landlord is looking for property management, hit that link in bio. Let's get your real estate journey started. This is Austin Smith and John Soto with the Real Estate Blueprint Podcast, signing off.